All right, financial issues now. This first case, we'll talk about it more for interest's sake than the fact that it has a large degree of applicability, depending how sophisticated a taxpayer you are. If you're very sophisticated and aggressive, still got a lot of applicability. So this is a case called Alcatel, a large public company, and a very interesting case about what are wages. Okay? So in the Income Tax Act, it says that salary and wages, SR&ED salary and wages are in to the extent that, salary was incurred for SR&ED activities. So in the case of Alcatel, they had the SR&ED activities. It was approved on the technology side. And then what they said was that during the year, some of the employees had exercised stock options. And what happens when you exercise a stock option is it creates an employment benefit on your T4 slip. Does anyone know how that works? I'll walk through that very quickly without giving a crash course in stock options here. But if we have a stock option being issued, there's two types of companies. There's a private company and public companies. Okay? And there's different implications and issues at each stage. And we'll only talk about the public company part here because of what Alcatel is. So there's a couple different steps. There's the issue of the option. There's the exercise of the option. To buy the stock. And then there's the disposition of the actual stock acquired by that option for the capital gain or loss at the end of the day. All right? What happens in the case of a public company here is at the issue of an option, nothing really happens. Okay? What they want to do is they want to issue an option to buy the stock at today's value or higher in order to make the tax rules optimal, right? So in other words, if I have a stock that's trading at $100 today, and I give you an option to buy it at 90, we got a problem, because you already just made $10. That's called a bargain purchase option, and that's going to cause negative tax effects down the road, right? But public companies are pretty smart. They're not going to make that kind of mistake. The reason that you don't have a bargain purchase option, so that if my stock's trading at 100, I give you an option to buy it at 100 or more than 100, right? So that you're going to work hard to make our stock value go up for our company, so that your stock goes up and we all win. So what happens then is if there's no bargain purchase option, when you exercise the option, let's say we exercise the option when the shares are at $200 now. Okay? So what happens is we have a $100 gain or benefit, of which $50 is taxable income, right on your T4, okay? And $50 is tax-free, very much like a capital gain. You don't have to pay tax on the other 50 if you didn't have a bargain purchase. Okay? If you had a bargain purchase here, then you pay tax on the whole thing, which is why companies aren't going to mess that one up. All right? This taxable income then becomes part of the cost base, so your capital gain or loss is determined on that when you sell it at the end of the day. Now, the important part here is this $50 of income goes on the T4 slips of the employees for $2.2 million at the end of the year. What CRA argues, that I think is a brilliant argument, is they say, yeah, but we're on the income statement. It doesn't show salary and wages on the income statement. You understand? When you exercise a stock option, the company doesn't get any money. It actually just goes on your personal income tax return. There's no wage expense or anything on the books of the company. Kind of like if I had IBM shares and I sell it to you and you sell it to someone else, IBM doesn't get any of that money. It doesn't even see that transaction. So CRA correctly argued, I thought brilliantly argues, show us, there's no expense. Section 37 says you have to have an expense. Where's the expense? Show me on the income statement where there's wages, anything, like you'd expect. And what's really cool here is that the judge comes back and he says, no, there is a cost. It's not an expense on the income statement, but there is a cost to the company. They've diluted their ability to raise more share capital because of issuing this. I'm thinking like, whoa, that's really thinking outside the box. But the client was right because they said that the definition of salary or wages in the Act, 248 sub 1, says it includes everything sections 5 to 8 of the Act. You go in there, boom, stock options. It's part of sections 5 to 8. So it's clearly in. The justice is clearly in. Now, what happened is they win, they get all the credits for all the stock options. Parliament decides that's really not in the intention of the legislation. So our elected officials decide that's not something that we want to pay credits on. So they change the rules that after November 14th, 2005, this no longer applies. So I'm saying, well, I guess it's not really that significant unless you really want to talk about, what guys in the big four firms would do, which is to say, well, that legislation is part of Bill C-43, and that's not passed yet. So technically, that's not law, which means you can still do this. Depending, again, how aggressive you want to do. I'm going to guess there probably are guys doing this right now, today. And until that law gets passed, they're grabbing all that money. Okay. This one, CDD REM, really had specified employees. And it's kind of one of the first cases that we'll talk about wages. And we'll talk about a few of them. And really what happened here is they're dealing with arm's length. So I believe these guys were paying their companies, or non-arm's length companies, instead of paying themselves salary and wages. And this brings a couple of issues into play here. So the question is, these payments to specified employees, do they have to keep timesheets and things like other employees would? And the answer is yeah. Just because you're a specified employee, any employee has to basically keep documentation that shows what they did in relation to the R&D, track their hours, and tie it to what they did. Now, what they did is the owners paid themselves their companies, right? And since 1996, there's definitions that say any payment to a non-arm's length party is ineligible. And particularly the owner-managers, they're saying the only kind of payments that we want is salary and wages. And the reason that they want to get salary and wages for any employee is that they know they got their quote-unquote pound of flesh. That if I paid you salary and wages, I have to withhold taxes and send them to Heron Road in Ottawa on the 15th of the month, right? And if you're in the top marginal rate, you're paying 46 cents on the dollar in tax, and we're kicking you back 20 cents on the dollar in credits. So it's what they call a hedge transaction. The only way you can get more credits is to pay more wages, which puts more money in the CRE coffers than they actually pay out in credits. They can't possibly lose. Right? Now, if I pay on management fees or whatever, I don't know that I got any tax, because you can pay your kids, you can pay your whatever. You may not pay any tax on that money. If you had good accountants, it all just disappears, right? So salary and wages is something, they got a T4 slip, they know what their withholdings are, they're going to give you the money. When they can trace an employee to a T4 slip and what you're claiming for the wages is in line with what they got for the calendar year on the T4, they're generally pretty happy. If they can't make that link, again, you're going to have problems. Now, one of the key things here is, I believe these shareholders were like 50-50 shareholders. They didn't control the company, and they weren't related by blood, marriage, or adoption. Okay? So, some of the key points here is understanding the different relationships for tax and what their implications are, and they're particularly applicable for SR&ED. So the main kinds of relationships that you're going to see of corporations for tax effects are the following three. The first is associated corporations. Does anyone know what associated corporations mean? What makes two corporations associated for tax purposes? Any guess? Control. Control, basically. So the Act calls it control. And there's two types of control. There's what they call voting or de jure control. I have more than 50% of votes. That's it. It's clear control. There's another type of control that you could get caught by. We're going to talk about that later, and you want to be very careful, which is I don't actually have more than 50% of the votes, but I have enough influence that I can force the company to do what I want. And they talk about incidences like, okay, I only got 40% of the votes, but I also have a demand loan for $1 million that I could call tomorrow. And the company doesn't have the cash, so if I call it, I can make it do anything I want. I can force it to do things that I want. And if in fact, I control the company directly or indirectly in any manner whatsoever, is what the Act says, then I'm deemed to control it. Okay? And that has effects on different things. So what are the effects of association? So if I have an associated company, say I'm like Donald Trump, I have 130 companies. The law says as long as I got them, I can legally open 150, 200 companies. As long as I file tax returns each year, that's my right as a taxpayer. So that's my interest. But what the law says is, even if I don't do R&D, the first $500,000 that I make in active income each year, I pay a much lower rate of tax, roughly 18%. And as soon as I go over that $500,000, it goes up to around 35%. My tax rate doubles. Okay? So in the absence of these rules on association, what I do is, I'm a guy like Trump, as soon as this company goes over $500,000, I just open another one, and another one, and another one, and another one. And I keep them all under $500,000, and I save $60,000 in tax every year, every company that I do, right? And I pay my accountant $1,000, I'm $59,000 ahead. CRA is wise to that. They say, you're not the first guy to think of that. There's a rule called association, which means, yeah, you can legally own all the companies you want, but as soon as you control them, they share certain limits. Okay? So they're deemed to be one company, and when they in aggregate are over $500,000 of income, you now pay at the higher rate. Okay? And you can have as many as you want, but when in aggregate they go over $500,000, you pay at the higher rate. And you also share the small business limit, the $3 million expenditure limit. Okay? So when in aggregate you go over that, again, and your incomes of all that group help phase out that limit. So you have to look at all the aggregate incomes of all the companies to determine if you're qualified in the next year. So the effects are phase out of limits. Right? So it could be SR&ED, could be the small business deduction limit, whatever you want. Right? All right, so I'll go through this because this is going to actually apply to a couple of cases that we look at. So this is the highest level. You control the company, you're associated. And we can do some neat things to disassociate companies. That becomes a real value-added thing. The next type of corporation is a related corporation. It's important to understand this, to understand the issues here on what kind of payments are we making. Are our payments arm's length or non-arm's length? And I've seen this mistaken a lot, where I've actually picked up clients where another SR&ED consultant said, oh, you can't claim this because it's a non-arm's length payment, but it actually was an arm's length payment. They just didn't understand the definition of arm's length. So we're going to talk about that. So what's the criteria for related companies? Does anyone know? So control, this would be section 256 of the Act. This would be section 251 of the Act. Related is, we're related by blood, marriage, or adoption. Okay? So if I'm related to someone by blood, marriage, or adoption, we're related. So I'm related to my brother. That's it. So if I got a company, I own 100% of my company, my brother owns 100% of his company, we're still related companies, right? Even though there's no cross ownership, nothing. Anyone know what the effects for tax purposes are for a related party transaction? The rule on related party transactions is the Act deems them to be done at fair market value, okay? Whether you do R&D or not. What that would mean is, let's say my brother's company is in a business and they would normally sell something for $100, right? On an arm's length transaction. But my brother decides, because I'm his brother, he's going to sell it to me for $80. The Act will punish us for that. Does anyone know how they do that? That's not allowed under the Act. The Act will deem that transaction to take place at fair market value. So the way they punish us is they say, okay, it was worth $100 fair market value. Even though my brother got 80, he's deemed to have received 100. Okay? So he pays tax on the other 20 that he never got. Okay? But on my side, my cost base, since I only paid the 80, I don't get the 100 that my brother paid the tax on. I only get to use the 80. So we both pay tax on the 20. You understand? It's intended double tax, and it's meant to be like that to discourage you from doing any related party transaction at anything other than fair market value. So, transfer pricing, all these kinds of things become big issues where accountants make a lot of money on stuff like that. The last of these is what they call connected corporations. This one's usually not known. Basically, a connected corporation is if you hold greater than 10% of votes in value, and the effects are that we can send dividends between those companies tax-free. Okay? So that means, usually if I got a bunch of companies all working together, I can either file these paper elections and shareholders' resolutions to transfer expenses back and forth between the companies. Total waste of time. Just shows me that I don't know how the companies work, because if they're connected corporations, which they have to be, which usually to do that they're associated corporations anyways, which means they're, by definition, they're connected, I can just dividend that income up or credits up tax-free, move it around however I want anyways, right? So again, sitting there and filing elections to transfer expenses from one arm's length company to another, and then, so you e-file your returns, but you have to send in paper copies of the shareholders' resolutions, which get lost and take 3 or 4 months for them to match up. You've just delayed your claim 2 to 3 months, right? And that you're always going to have those problems. So again, when you're doing those transfers, I would typically explain to my client that it's completely unnecessary. If you understand how the Tax Act works, you're probably a connected corporation, you can just move that up. You don't have to file anything with CRA. You just move it. It's your right as a taxpayer. You just dividend it up or back or forward. Okay, now what happened here is, the third definition that's important here, not on company ownership, but on employees themselves, is a specified employee. And the CRA got confused here. So does anyone know what the definition of a specified employee is from the other courses? Come on? Yep.
More than 10%.
Right. Anyone who owns 10% or more of any class of stock, or anyone related to them by blood, marriage, or adoption. So you got to be careful here. Often, you know, the president's son who's sweeping the floor in the summer, hey, if the president owns more than 10%, they all get caught. So you want to make sure you capture all the specified employees. What it says is that a payment to a specified employee has certain limits, okay? 5 times yearly maximum pension earnings, let's say, for the wages, and 2.5 times YMP as an example for your proxy election, your salary base or overhead, if you go that way. So what happened here is, these guys each own, say, 50-50 of the company, but they didn't control it. And they weren't related by blood, marriage, or adoption. They were arm's length people. Okay? They were just business partners. They weren't relatives. So that means neither of them really control the company. Right? If you don't control the company, then you're arm's length. Okay? If you control the company, you're not arm's length. If you don't control it, and you're not related by blood, marriage, or adoption to the people who do control it, which they weren't, you're called an arm's length employee. Okay? And an arm's length employee, an arm's length person, so even though these people were specified employees, they were still arm's length. They owned more than 10%, but they didn't own more than 50% to create control. A contractor payment to an arm's length person, even if they're a shareholder, is still okay, because they're still arm's length. You understand that? So again, I see that being missed a lot. A lot of practitioners mistake the definition of specified employee, the 10%, with arm's length, which is control, which usually means de jure 150, unless they can argue de facto. We'll talk about how you want to avoid de facto a little later on, which is really the big risk there. Okay? Now, again, since 1996, they're saying any non-arm's length payments to owner-managers, they want it to go in the form of salary and wages. However, if I'm a 50-50 owner with someone who's not related by blood, marriage, or adoption, I'm actually still arm's length. Okay? The Act has a concept of no control. So if I'm 50% Canadian owned and 50% US owned, I could still be a CCPC, believe it or not, Canadian controlled private corporation. It's a negative definition. It's not controlled by any combination of public companies or foreign parties. So 50-50 still isn't control, as you would think. It's no control. Unless they can argue de facto, loans, other kinds of things. And they have a whole list of things that they're going to look at to see if you have undue influence. And we'll give some examples of that as we go along. All right. Now, Synchrosat was one. Well, it was an interesting one. This client got a little too aggressive. And the Act says you have to do, the rules say you have to do a reasonable allocation of the hours to the R&D activities versus non-SR&ED activities. What the client did here is they said, well, we had 7 projects in the year, or 6 projects, 3 were R&D, that took 5 months, and the other were non-R&D, which took 7 months, but 100% of the salary that we paid ourselves for the year was all related to the R&D projects, and we did all the other stuff for free. And, well, hey, they went for it. And the judge said, that's not reasonable allocation. You got to take your total hours and allocate the appropriate percentages. Now, I'm saying, okay, well, why did I even put that in? That's one of those black and white ones, but I'm saying it does create a gray area, which I'll talk about in there. And the way I would have planned that is a little more advanced and saying, well, these guys were paid hourly and whatever, and that's pretty unreasonable. And they were kind of working, 9 to 5, so it's unreasonable to say, you're not going to be paid for that time. But one of the key things that a reviewer is going to ask the owner manager on every file of a small business client is they're going to say, standard financial review question, anybody? How many hours did you actually work in the year? Right? Because the average employee, I'm saying, works around 1,800 to 2,000 hours a year. 40 hours a week, 47 weeks a year, right? Because they get 3 weeks of vacation and stat holidays, or 5 weeks of stat holiday, 5 weeks of vacation and stat holidays added together. So around 2,000 hours. But the owner manager is going to come in and say, I work at Saturday, I work 3,000 hours a year, right? So they're going to take your T4 wages divided by 3,000 and say that's your hourly rate. Your total of what you earned less the total of what you worked, which is a reasonable basis to do the hourly rate. If you're paid hourly, I say, and what the act says is you have to do a reasonable allocation, that this wasn't reasonable in the judge's eyes. But the reality that I see for the owner managers is to say, okay, let's set you at a salary of 5 times YMP, or let's say $240,000. So you make $20,000 a month. And what we'll do is we'll put it on salary saying you have to work 9 to 5 and after 9 to 5, if you work overtime, you don't get paid anything. Kind of like when I used to work for a big 4 CA firm, I would get my salary and then I would work all these extra hours and they didn't pay me anything. It's like, that's free work. That was it. If you didn't suck it up, you weren't part of the team, you had to be willing to work for free. So what I'm saying here is, if that's the situation, that's different than being paid hourly. If my job says, and this is how I win this with CRA, because they still argue this all the time. I'm saying, well, Duke Westminster decision says I can arrange my affairs to pay the minimum amount of tax the law allows. If I'm paying myself, $240,000 a year or $20,000 a month, and I'm expected to work 9 to 5, I'm going to do my R&D from 9 to 5 because that's my primary job. And then when I'm not getting paid after 5, then I'm going to choose to do all my non-SR&ED activities because that's my choice. Would I do during my paid hours or not? I tend to win on that one because that's deemed to be a reasonable allocation. Right? I'm saying that, I'm not saying that, the whole 7 months I'm paying myself, I'm going to do what Synchrosat did, but if I have a reasonable basis for allocation, i.e. I'm not getting paid for overtime and I choose to do my SR&ED during the working hours that I'm getting paid for, there's no case on this so far, but where I've threatened that, that's one of the ones where the CRA is going to negotiate with you. Okay? Again, you want to negotiate your contracts and arrange your affairs ahead of time to do this. It doesn't work if I'm being paid hourly. It only works if I'm paying salary. And ideally, what I like to do is have a written contract for that employee as you would any other arm's length employee. Treat them just like everyone else. Hey, this guy doesn't get paid overtime and neither do I, so this is the way we do it. And the way that you win in court is to make the CRA's position look ridiculous. Okay? That's what a lawyer will tell you. So what I do is I say, well, without this rule here, if the CRA wins on this, and I have to factor in all the hours, even if the guy's on salary, that's putting me in a position where I may now have my head of R&D, I have to have my security come at the end of the day and escort this person out of the building at 5 o'clock to make sure they don't do any non-R&D stuff. They don't help with the company Christmas party. They don't do anything to help the company better so that they have a better job in the future and a more successful employer. It's discouraging me from doing that because now I'm going to lose the SR&ED money for this individual that actually volunteered to work for free. It's going to cost me, and that's not the intent of the act. Okay? And now that makes the CRA's position look a little abusive or mean, let's say, which is again going to work in the judge's favor, that whereas things are arbitrary or particularly abusive to the taxpayer, they're always going to side with the taxpayer. Again, so it's a matter of really structuring that. And understanding there's the difference between salary and wages. Fixed salary versus hourly wage. If it's hourly wage, it's hourly wage. There's really no argument there. You can trace it to the hours. But if I'm working free overtime because I'm on salary, my argument is I have the right to choose which affairs I do during my business hours and which ones I do for free. This, again, is a similar case of a very similar fact scenario, ergo research, so I won't go into most of them. All right, any other questions on wages? It's an exciting area. You could go on and on. There's a whole bunch more cases. Materials. So Materials really have two main types of decisions. Materials are either consumed or transformed. Does anyone know the difference between those two? At your end. What would be a difference between consumed and transformed in the CRA's view?
Transformed is usually prototype, consumed is destroyed or rendered valueless.
Exactly. So what they say is the definition of consumed, if you read their paper, is consumed means it's valueless at the end of the year. It has no more commercial value whatsoever. You're not going to put it in commercial use. You're not going to sell it. It's done. It's usually been scrapped. It's gone by now, right? So material, stuff like that. Transformed is, let's say I build this prototype. Oh, I put $250,000